Hey everyone, good morning. We're going to get everything set up here real quick. I'm going to make sure I get made the host. And thanks you guys for joining in on Zoom. And you guys are going to miss out on some food, but hey, at least you get to get some knowledge. So that's all that matters today. All right. Well, let me see if I can. Okay. You got it pulled up.
You're in, and it was updating.
Oh,
You like went to click it, and I'm like, oh my god.
Yeah.
Okay, you are the host now.
Okay, sweet.
Okay.
Sweet.
All right, let me know if you
We
need
saw a
anything
couple
else.
people on Zoom, so we'll see whoever else.
Yeah, you've got 4 on Zoom.
Okay.
I definitely feel like it's like the biggest, like obviously 1,
Okay,
and then it's
guys.
16,
All right, let me see if I can
21,
share this. Here.
30, 50, 65.
No more, gotta change insurance, gotta go to Medicaid, gotta go to the government crap. That's some of it's. Really, though, right?
Okay.
I don't know, I didn't use my insurance to begin with.
Okay. All right. Okay, everybody on Zoom, give me a quick shout to see, but let me know if you can see this. Hopefully you guys can view it. I shared my screen.
Yes.
Hopefully everybody can see. You see the cross-country loan estimate, right?
Yes.
All right, perfect. Thank you so much.
Cool.
All right. Well, good morning, everybody. I know it's about 11:03 now, so we'll go ahead and get started. I know there'll be some people kind of trickling in here to, to hopefully be able to join. But thanks for joining Kate and I today for our class to kind of discuss, the process and everything about loan estimates and closing disclosures. And so I really think this is a really important piece, for every borrower's transaction to kind of, understand, what potential fees could be involved, what is going towards what, who is covering what, if there's any concessions, tied or seller credits, things like that. This is just a real important, piece for you guys to kind of have an understanding of on each and every transaction. So, Kate, I don't know if you wanted to say anything real quick before we get started.
Yeah. So I think the biggest thing from a realtor's perspective, and the purpose of looking at a loan estimate or a closing disclosure is I would say the biggest thing people say to me is that, well, they're saying they're getting a better deal from another company, or they're going to be getting charged less money from a different company. And the really important thing for you to do if you want to work with Cross Country Mortgage and obviously get your transaction to close, is being able to understand if this is like a locked-in loan estimate versus like just a quote that someone's getting versus a pre-qual. And looking at a loan estimate side by side is definitely how you're going to be able to help your client navigate that. Obviously, we do that on our end with the client, but
Right.
if you have this knowledge, it's also helpful. And I do think just from a realtor's perspective, it's interesting to see what different companies charge clients, and what all goes on the loan estimate. So this is super helpful for getting second opinions our way, for comparing different kind of programs, all kinds of good stuff. So yeah, thanks for coming, and I definitely think this is super helpful.
Yeah, absolutely, guys. And what I put together for you guys today was I wanted to see you to see a couple of different options of what comes out to the borrowers initially when they get a loan estimate, and then when we get their final numbers from all the third parties involved, what all that entails. Okay, so I did a couple of different options. I did this first one that we're going to discuss is just a standard conventional 30-year fixed option, okay? And so this particular borrower, okay, the purchase price on this transaction was $122,000, okay? And at this particular rate too, it was a 6.75. Obviously, this one was a little while ago, so don't get too excited, but this is all for example purposes, but hey, it is what it is. But conventional financing with the borrower putting down 5 or 3%, okay? And the interest rate at the time was 6.75. And so you can see how it's broken down here. First, we go over, and this is the loan estimate, guys, before I get too ahead of myself. This is what goes out to the borrower initially, okay? What our system does is it takes the purchase price based upon what the borrower is planning on putting down, okay? And they send them the loan estimate that includes all the potential fees that could be associated with their loan, okay? They may not all be charged, but for compliance purposes, you know, we have to disclose properly, because whatever party doesn't disclose, whether it would be a title fee, you know, credit report fee, anything like that, if the proper disclosures aren't done up front initially, whatever that amount is has to be covered by that party. So, and it can't be charged later. Okay, that's what's vital about when we have, that's why we always do our due diligence when we're sending out disclosures to each and every borrower, to make sure that, hey, this is what they could potentially be charged. But then Kate and I have the conversation with them to let them know, hey, this may not be charged to you. And once we get your final numbers, you'll have a more accurate idea of what your cash to close is going to be. Okay. All right. So now as we move down to the loan estimate portion here, again, where the payments are, this is where it's broken down to. So at that rate, the 6.75, the borrower's principal and interest would be $767.55. Okay. That's what goes towards their mortgage. That's their principal and interest, and what they, you know, is their fixed amount, you know, for the duration of their loan. Okay. And then we have the mortgage insurance in here. This particular borrower with their credit score, the mortgage insurance would be $75 is what we estimated initially. And the escrow account for your taxes and insurance, we estimated it at $225. So for the first 13 years, which, you know, this timeline is basically where they would have no PMI after the 13th year if they just made their regular payments and didn't pay extra to kind of get their principal down. Their total monthly payment would be $1,068 even, okay? And then after that, for the remaining 14 to 30 years, their total estimated monthly payment would then drop. That $75 drops off and gives them a monthly payment of $993. Okay. Any questions at all so far on the first intro kind of stuff? Anybody on Zoom? Everybody good? Just, yeah, definitely, you know, unmute and, you know, start talking if you want it, if you need anything, and just let me know. Okay. And now what we do is we go down here to where it shows what is all going to be included in their payment. Like I showed you there, the property taxes and homeowners insurance, these boxes will automatically be checked, you know, when the borrower is escrowing everything into their mortgage payment. Okay. All right. Now we scroll down here and go over the fees and everything that got associated with this. So right now for this particular borrower, it says estimated cash to close, $8,160. Okay. And their estimated cash to close, which includes their down payment and their closing costs, will be $6,331. So initially, a lot of people, we always make sure that we discuss this section here, because they're like, okay, what are these two numbers? Okay, why is the other one smaller? Why is the other one large? You know, whatever the case may be. So this is where we go over everything with them when we get this actual closing cost breakdown to show them what the borrower is going to be receiving. Okay, so we're going to come back to that. All right, so, okay. All right, so here we go. So here's where CrossCountry comes into play. All right, so loan costs, okay? CrossCountry has an $895 underwriting fee and a $795 processing fee, okay? So on this particular loan, their fees for this loan to be originated by CrossCountry is $1,690, okay? That's just what our fees are, okay? Now, as we go down to section B here, we put in there what their estimated appraisal fee may be. So we put in there $635 as the appraisal fee, because that's probably pretty standard right now, or right around that amount. And then we also disclose a $200 reinspection fee, credit report, and flood cert. Okay. Now, does anybody want to answer why we have an appraisal reinspection fee put on here? Does anybody want to throw a shot at it, with why we have to put it there.
Just in case that you have to send out a second appraisal.
Yep.
FHA or whatever the case might be, and not far.
Yep.
I'm not again.
Exactly. I'm not sure if you guys could hear it, but Aaron just answered that question. Exactly. So the reason that it's on there is because it could possibly happen. We don't know. Nobody has an idea what the future holds and what the shape of this house is going to be. So that $200 reinspection fee has to be put on there, because if it's not, then, you know, the appraiser or us more than likely will probably have to eat that fee if another one is done. And we can't have, we're really not the business for charities for all the time to help those kinds of things. So this is why compliance and disclosures is so important. Okay. All right. And then as we move over here to here, let me scroll down, then I'll go back up so we can go in order of this. Okay. All right, guys. So section C, services that the borrower can shop for. Okay. So everything on here, you'll see the survey fee. Okay. The title closing protection letter, courier fee, EDOC fee, lender's title insurance, notary fees. All these fees that we're talking about here are all third parties. And you know, and they all come from the title company. So this is what the title company sends over to us and how they itemize each potential fee that could be associated, you know, with this transaction. So it goes all the way down to, then you have the tax related service fee, title binder fee, title exam, wire transfer, all of those fees, you know, that could be associated with this transaction. Okay. And this is what automatically populates in the system based on what the purchase price is and the loan amount is. Okay. So the system just kind of guesstimates until we get our final numbers from the actual title company. So these numbers are just kind of based upon each scenario. Okay. All right. And that amount total between the title services and the closing costs that I mentioned, between section A all the way through section C, that total amount down there ends up being $46.97. Okay. So that's the amount for that particular part of the initial part of the closing costs. All right. Now we're going to scroll back up here and go over the other costs that could be associated with it. Okay. And this is where you get like the taxes, other government fees, and prepaids. Okay. So recording fees and other taxes, the system has estimated it at $316, transfer taxes $491. Okay. That's where those, if they are part of this transaction and they're considered not to be an exact itemization under the appraisal fee or the title fees, that's where those get slotted in the other costs. Okay. And then now we go to the prepaid, which is section F. So in this particular transaction, homeowners insurance premium, which is their home insurance. So whatever it is, right now we're basing this off of $85 a month, okay, for home insurance. So 85 times 12 basically gives you that 1,020 is what we're holding for that first year. Every insurance company in the United States, they all like you always pay their first year premium up front, whether you're escrowing it or not. Okay, that's just kind of how they work. And then you'll scroll down and you'll see the prepaid interest portion of it, which is depending upon what time of the month you're closing, what day of the month you're closing, there's certain prepaid interest that is going to be kept so that when the borrower makes their first payment, you know, here's a good example. So say we're going to be closing, you got a loan that's closing October 21st. Okay. And so between October 21st through the 31st, they have to hold that extra, 10 days of interest to make sure that that's covered until the borrower makes their first payment. So then they wouldn't even have a payment until, December 1st. That's where you get that time off where, you know, you get that month gap in between starting your payments. That's kind of how that works. Okay. So that's a good point to kind of take a look at, because a lot of people are like, what's this prepaid interest? Why are they getting charged interest? It's not. It's all due because it's covering them until their first obligated mortgage payment is to take place. It covers them through the duration of the rest of that month. Okay. All right. And then here's section G. Here it's listed again where we put in here, okay, homeowners insurance, $85 a month. We're holding 3 months of that. Okay. Always a big question. They're like, okay, well, if you're taking 12 months of home insurance, Cliff, on section F for the first year, why are you also holding an additional 3 months in the escrow account? Well, that's a very good question. That's again, depending upon what time of year is, okay? So that first home insurance premium that you see on there, that immediately gets paid and it covers their insurance for their first year, okay? Then whatever part of the month we're starting in, say we're starting at this particular loan. Let me see when this one closed. I think this was, let me see if I left the date on here. Thought I did, maybe I didn't. Okay, well, we'll just kind of figure this one out. I think this one was done in March, I believe, March or April, something like that. But anyway, I'll just kind of go back to where I was at anyway. But anyway, when it comes to home insurance, the reason that we kept 3 months in this particular example here is because that covered enough to be where when the homeowner's insurance is due again, the remaining, 9 months that'll be applied to that, you'll have your full year again, and then the escrow account will have that whole amount of 12 months in that and separate in the account ready to be paid. So we hold 3 months because it catches us up when we start making payments, that by the time the year comes around and the insurance is due again, you will now have the full amount of the insurance in there, which it will be paid at that time. So you'll have borrowers say, hey, I got something in the mail that said my home insurance wasn't paid yet, or my property taxes weren't paid yet. If they're set up with an escrow account, it's normally going to be in process. So depending upon whenever their servicing department is that receives their money when CrossCountry sends out the check for the home insurance or for the property taxes, it just depends on how quick their internal system is to turn that around to get the check in and to get it cashed. So you'll always have clients say, hey, how come my taxes weren't paid yet or my insurance wasn't paid yet? More than likely it has been, they just haven't gotten it yet and it hasn't been through their processing system. Okay, but that's what we kind of want to make sure we at least touch on in that regard, so people have an understanding where their insurance is going to with an escrow account. Okay, and then the rest of it on here on section G is that we're holding 4 months for property taxes. Same deal with what the insurance is. The reason they're holding 4 months right now initially is because of when taxes are due again, because taxes are paid in Ohio every half. They have enough in the escrow account to make sure that those are paid after you start making your monthly payments when the rest of it gets applied. Okay. I know that was a lot, but I was trying to get as much information in there, but let me just pause for a quick second. Does anybody have any questions or any comments or anything at this stage?
Taxes are in arrears, right?
Correct.
So if why are you taking 4 months ahead of time if we're in arrears?
That's a great question, Ken, because we're going to get to that once we get to the final closing disclosure. Ken led me in right into my next transaction. So this is perfect. Perfect. Okay.
So now you're all.
Yeah, right. I didn't pay him for that one either, guys. That was nothing. That was on his own. So, but anybody from Zoom, everybody good? No questions? Okay. Just wanted to make sure before we move on. All right. All right, guys. And then here, section G, they normally just put that on there as considered other, like if there's any kind of brokerage fee that could be associated with this, or an additional title owner's policy. Like you'll probably see this, and Stonegate can even probably touch base on this as well. When they're meeting with clients, initially when they get under contract, and then the title company will send out their information. They'll be like, hey, welcome to, getting your purchase done. We are Stonegate Title. We are here to help with your transaction. They give them all the information on what title insurance is, what it could do, and their process. So the reason that we add that additional part here for that optional title insurance is if a borrower wants to get extra title insurance, because in some cases there's the mandatory title insurance, which is in section C here that we already listed, that has to be a part of the transaction. Okay. This optional title insurance is if the borrower would like to have extra protection, down the road, just in case if, say, for instance, there was a seller that owned this property 15 years ago, all of a sudden wants to come back to the picture and be like, hey, I still have ownership in this property, and saying that maybe they didn't get their proceeds or what have you. That extra title insurance is what helps cover you if any kind of, event or anything like that would possibly ever happen. So I just wanted to kind of give you a quick 411 on that. Okay. All right. And so now that we got to that, the total calculation between sections E all the way through section H, then total 3,463, okay? Which then combines with, so this is your escrow account plus your actual costs and fees for the transaction. As you'll see on here, that total amount then came to 8,160, okay? And then here's another breakdown too of where we're talking about. Is on here you'll see the total closing cost, the 8,160, and then the borrower's down payment funds, which was in this particular option was $3,660. Okay, that's their down payment. Then that $1,000 deposit, that was their earnest money deposit that they had towards this transaction, making their total cash to close, including their down payment, $6,331. Now you'll see on here where it says adjustments and other credits, okay? So that section there, that could be a couple of things. It could be the seller credits, if they got any kind of seller concessions, that amount could include the property tax proration or half the titles policy fees that they're being credited from the seller. All of those kinds of things go into that particular section where it says adjustments and other credits, okay? And that's why they put a minus there instead of it being a charge, because that is coming off their total amount for closing. So as you'll see on here, the 8,160, and then their down payment, the 3,660, those are amounts that the borrower is coming to the table with. That shows them, hey, this is what's needed for that transaction. That's why there's no minus sign on there. Then we break it down more. We give them the minus 1,000 because they're earnest money deposit, because that comes off. And then the adjustments and other credits, the 4,489, bringing their total cash to close at 6,331. Okay. And that includes everything. All right. So any questions at all on that before we get into the loan estimate on this portion of this transaction?
One thing that's also worth noting is I, in particular, work with a lot of folks who either do OFA or CCM Smart Start. And they always are wondering why that doesn't go on the initial loan estimate. Because with CCM Smart Start, obviously, cross country mortgage covers 2% of whatever that down payment is. And the reason is, I just want to be clear, like they need to see what their entire loan estimate is broken down as before any kind of credits or any kind of programs, any kind of whatever we're doing on the back end. But that's always the first question I get when someone's doing any kind of down payment assistance is like, I didn't think I was going to have this much money. So just again, to be clear, if your buyer is using any kind of down payment assistance program or specialty program, especially through cross country mortgage, it won't show up in the calculated cash to close amount on the loan estimate because it's not being applied on this loan estimate. However, once we get 3 days or once we get the actual cash to close amount, once we process everything through, they'll be able to see it as a credit coming on their final estimate, if that makes sense.
Yeah. Everybody hear that? Hopefully. Should have. Okay. All right, good. All right. So now I'm going to scroll down on the next pages for this loan application here. All right. Well, here I'll just kind of touch base. I won't spend, too much time on this. This is basically goes over, the duration of what the APR is, and over the course of the first 5 years, what the borrower has paid towards principal and interest, mortgage insurance, closing costs. This is kind of like the way that the breakdown comes over on the loan estimate. So within the first 5 years, you see that $55,446 total they will pay towards principal, interest, mortgage insurance, and loan costs. So it's the new version of, when you get what the APR is on any kind of financing. Okay. All right. So we'll just get into these numbers now. Okay. So now we're like, okay, we're at the closing table. Now we know exactly what's going on. We've got all of the information from the third parties involved, which is the title companies, everybody that's involved, the appraisal, everything that we know. Okay, this is what we're going to do.
You guys probably all know this, but just for reference to, just so you understand what that timeline of receiving these documents looks like from a borrower's perspective, the loan estimate goes out as soon as we go under contract. So when you go under contract, you send me or Cliff the purchase agreement. We work up their loan details on the back end. Within 1 to 2 business days, they'll receive those first set of documents, their loan estimate. basically because they have to sign their disclosure saying, I'm ready to officially apply for a mortgage. That's what that is, right? So when they receive their loan estimate, it's not just for kicks and giggles. It's because they're saying, yes, this looks correct. Even if we're gonna adjust some things later on, or if I'm still thinking about buying down my rate, I'm still thinking about how much I want to put down. They're recognizing that this is overall what the loan is going to look like, and they're agreeing to start the mortgage process, just for reference. So this all happens before the home inspection usually. It happens within 1 to 2 days of us receiving the contract. Their closing disclosures don't go out until about 5 days before they actually close on their loan. So they'll receive a lot of updates
Right.
from point A to point Z, but the two things we're showing you today are kind of like bookends, like the first thing that they receive and then the last thing that they receive.
Exactly. Yeah, because during the process, there could be changes, and we'll get into those kinds of things when they do happen. But yes, initially, that's what they do receive. So that's exactly
And
right.
I don't know about you,
Mhm.
but for me, like when we initially send their pre-approval, we'll usually say, can you please send me the address of the property that you're looking at? And we'll go over these numbers with them 99% of times before they even go under contract.
Absolutely.
So this loan estimate that they receive typically is just a confirmation of this is what we talked about, sounds good. Every once in a while, I'll get a purchase agreement while they're already under contract with a different lender, and they're saying, hey, we want a second opinion. That's when we're like, okay, if you want to change anything, call me back. But 99% of the times for me and for my team, they already know all of these numbers because we went through what their cash to close was going to be, their monthly payment, their interest rate was probably going to look like before they even look at houses.
Yeah.
So their initial loan estimate that goes out is, again, 99% of the time, just a, yep, you're reminding me of exactly what we talked about before.
Yeah.
So far.
No, that's exactly it. And what's one point that to make what, Kate had mentioned is getting the address from these clients. So yeah, everybody that we work with, if they have a scenario and they're like, okay, Cliff or Kate, we want to make an offer on this property. I'm like, okay, let us get the address, because what's important is we get to go to the county and see what the property taxes are, so we can give them a more concrete estimate of what their monthly payment's going to be, maybe an idea, maybe what the tax proration might look like that'll be applied towards their cash to close, and so forth. So that's why it's an important thing. So really the only unknown factor at that moment when we're going over those numbers with them is maybe what their homeowner's insurance is going to be. But we can kind of guesstimate as almost as accurate and as closely as possible, for that. We do that with every client. Yes, Mike.
Assessments get going into this as well? If there are any assessments on the property?
That's a good question. Not necessarily. We don't really factor that too much into their cash to close, because if it's assessments and if it's not going to be applied towards what they have to bring, we don't really factor that into that too much. We absolutely having a discussion is a good topic to have, but we just really want to focus on what's it's going to be, what their bottom dollar is going to be. Yeah. But yeah, definitely the tax proration, we definitely factor in, but the assessments, that's more of like an after fact, I would say. Good question though. Any other questions before we jump into the final closing disclosure? Okay. All right. Well, here's a question for you guys. Okay, so when the final closing disclosure is ready, we get the clear to close, or probably even prior to clear to close, say we're about there. What is the timeline for the closing disclosure for the borrower? Like how soon do they have to receive that? Does anybody know? Yeah, 3 days of what? Yep. Yes and yes. So the borrowers will receive this, guys, a minimum of 3 days, 3 business days prior to the consummation of their loan. Okay. And
So Cliff,
yes.
if they get it on Friday,
Yeah.
does Saturday and Sunday count?
Yeah.
Is there a waiting period?
Who wants to answer that question? Does Saturday and Sunday count? No. So yeah, if they get it on Friday, when is the soonest they could close that? That would be ding, 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 ding. All right. So
You
good job.
win.
You win.
Good.
Yep. For anybody that didn't hear, when it comes to the closing disclosures days on Zoom, guys, it's 3 business days that they have. We want to make sure the disclosure goes out to them prior to the closing of their loan. So, and what's nice about this, because before you could get a closing disclosure on the same day and then be able to close the same day. I mean, there was good things about that, but then there's also bad things about that. Because if all of a sudden, say something changed in the numbers and they say there was an error, the title company didn't catch it, then the borrower has to come back in or have somebody else go back out to them and have to re-sign some documents that can approve this change. So this alleviates all of the misunderstandings and gives the borrower enough time to, number one, get their money in order of where they're going to be pulling their funds from, and gives them time to go into the bank or get a wire transfer, get all that kind of stuff set up, so they're not rushing the day of closing to try to go get their their certified check or their wire ready to go. So we've seen days like that be lots of fun, and then it's not. So, but okay, guys. So back to this one, $120,000 purchase price. So we're financing again the same amount, $118,340. Their interest rate 6.75 fixed. So their principal and interest payment $767.55. Okay, and as we scroll down here, like the first initial estimate on the mortgage insurance for this particular borrower was $75. So that ended up being pretty close. It was actually 5 cents cheaper. For this particular time now, it's $74.95. So their monthly payment, including their taxes and insurance, $1,060. Okay, so that $216 amount, that's what they're going to be holding for their escrow. So that includes their property taxes and their home insurance in that $218. The mortgage insurance, which is separate since they didn't put enough down for this particular transaction to cover, to not have mortgage insurance, that's what the breakdown of it's going to be. Okay. All right. And now we've got what exactly they're going to be receiving. So initially we saw their closing cost was a little bit closer to about $8,000, I think is what it was. And so now that we got everybody's third party fees in, they calculated the fees that didn't need to be charged. So now their total closing cost is $6,970.37. Now making their estimated cash to close $5,379.80. Okay. So now we're going to go over, okay, well, Cliff, how did we get to that? Let's kind of go over those details. All right. So we'll kind of go a quick itemization down this line, and so you can kind of see everything penny for penny. All right. So here we go. Cross-country fees. The only fees that we can control is in section A. So there's our underwriting fee and our processing fee. Those amounts didn't change. $895, $795. Our total $1,690. Okay. And as we scroll down here, the appraisal fee $635. So that's great. That actually matched up to the loan estimate. So their cost of their appraisal. Credit report fee was $138, which is actually a little bit less. I think we had estimated at $200. So once we finally got that fee in there, that's exactly what that was. Flood certification $8, $200 survey fee. So right off the rip, I'm already seeing a couple of things that have already changed from the loan estimate till now. And then what else real quick on there, it looks like it's missing that was shown on the loan estimate. Just on section B, what do you guys think? Yep, survey fees on there. What's missing? Anything that can, there you go. Yep, that appraisal reinspection fee, that $200 is now gone too, because it was not needed for this particular transaction. Okay, so all of those things will start to, itemize and update once we know exactly what the final transaction is going to be. Okay. And then as we go down the list here, now the title company for this one was Stonegate Title. So all of those fees that we get from them that came over from the initial loan estimate, they got updated with what their fees were. So that was very, very similar to kind of go down that. And then we'll scroll here to get the other costs with the recording fees, the deed, transfer taxes. All of that was pretty close. It's about $316, but this has actually ended up being a little bit less. Here's their home insurance, their 12 insurance, how much we held for them. So that was all kind of lined up what their home insurance was. That actually was a little bit cheaper. There was only $938. I think we had held $1,025 for that initially on the loan estimate. So that shows that that's went down as well too once they finally got their home insurance done. And then the interest per day from closing from 8/23. Okay, good. I can see the months around here now. So August 23rd through September 1st. Okay, so that's the only interest what they held per day to cover that portion of it, to hold them until their next mortgage payment is done. Okay. All right. So then again, it shows their monthly home insurance $78.17, and the property tax on the home $139.89. So that's how we got what we're going to hold in there for their escrow account. Okay. All right. And then obviously on other, like you guys will always be able to see you know, what commissions and things like that, that you guys know. This was a Keller Williams deal that I had. And it looks like the other agent on here was High Point Real Estate Group. So kind of breaks down what he was paid what, with what you guys know, and your guys' commissions payouts. All right, but here's a good breakdown of what we can see here too, because this shows what we disclosed on the loan estimate, which was their estimated closing costs were $81.60. Their final was $6,970.37. Okay, and then we shows over here where it says closing costs paid before closing. Initially in the loan estimate, it was $0 because nothing was paid yet, because that comes out in their initial application, like Kate said, on every borrower when they come to get under contract. So now it's showing the $635 where the appraisal fee was. That's what they paid. So that then is marked paid outside of closing, and it's always itemized on this section of the closing disclosure. Okay, and then goes down here again, and it shows them what their down payment was. So that doesn't change. They decided to put this amount down and not anymore. So it was $3,660. So those were equaled and matched up. Same with their earnest money deposit, the $1,000. We made sure that it was credited here again on the final CD to show them that this was already prepaid by them too. That's why you see that minus right there to get to be applied. Okay, and then adjustments and credits. The adjustments and credits we had were initially were $4,489. The final ended up being $3,615.57, because once we got exactly to see what the tax proration was and if there's any credits that were applied, that's what that amount is, making their cash to close $5,379.80 as opposed to $6,331. Okay, and I'll be able to show you where these other credits were too. Okay, so what we do, and what Kate had mentioned, this was a client of mine that got to take advantage of that CCM Smart Start. Okay, so this particular borrower was qualified for the 3% down program, where our cross-country fees, you'll see them right there, is what we applied towards their program. Okay, and it was $2,440. That's what CrossCountry Mortgage gave to them because they qualified towards their down payment. So everybody's happy. They loved that. Okay. And then, oops, sorry guys, I went a little bit too. I know I got a little crazy there. Hold on, I got heavy fingers. All right, hold on. Go back to. There we go. Okay, sorry about that, guys. Okay, all right. So you see where that's applied. Now, the other credits that the borrower received on this transaction too. Okay, we have the owner's title policy, which is a credit for them, and it was $453.37. Anything that's in section L is going to show where the credits are. Okay, because you'll have the earnest money deposit, and then our CCM Smart Start fees, which was $2,440. Half of the owner's title policy, which is $453.37, plus the tax proration credit that I had mentioned earlier. In this particular scenario, it was $722.20. So that was the itemization and the breakdown of all of their credits that got applied to their financing, making their cash to close $5,379.80. Okay, everybody good? Good understanding of kind of like a quick conventional first-time home buyer program, closing disclosure loan estimate. Good? Okay. All right. All right, so now we'll move on. And this is all the basic stuff. It shows, you know, myself on there. It shows, you know, who the real estate agent was with, you know, Keller Williams, this particular transaction. High Point, this was a Jamie Wolf, must have been the real estate or the listing agent. Stonegate Title, all those kinds of things that you guys have seen that before. But. Okay, so now we're going to go to option 2. All right. Now, what's important about this one, guys, and I'll kind of go through this one a little bit quicker, just because you guys have at least a good idea now of what these fees and everything is. This is just a good one that I wanted to touch on. This was another conventional, you know, program. This purchase price was only $75,000 for this transaction. The interest rate was 7.875 because this is actually a conventional OFA program. Okay, so now you can kind of see the difference of, you know, what's different than a traditional as opposed to one with down payment assistance. Okay. All right, so this particular program, the interest rate that OFA had at the time, because everything is based off of what OFA dictates. That's how this entire loan is set up. So based on their program
Sorry,
and
really quick,
yes.
I wanna like really harp on that because I've had questions about that too. So when someone uses down payment assistance
Yeah.
through the state of Ohio, we do not control their interest rate anymore.
Yep,
The interest rate is associated with OFA at the
Oh,
time.
there's a
and
question
it's payments every day. So, if someone is going with down payment assistance and they're upset about their rate, that is not something that we can change on our, just wanna make that clear.
Feel like you maybe guys compete about that?
Oh, I think it's
Yeah.
almost, I mean,
We did.
I would say 60 to 70% of the time, those folks who are using OFA are just so grateful to get a house because they
Yeah.
figured out a way to make it work for them. But
Mhm.
there's like that 30% of people who are like very confused
Yeah,
and they just don't understand. So just, yeah, to be clear, if we're using a state program, we don't control the interest rate.
right. That's exactly it. With any kind of down payment assistance program like OFA, the Communities First, all of those programs, other than our CCM Smart Start is the only one that we can control because that's us doing it. When you have another entity doing this, like an OFA or Communities First, they dictate the terms, interest rate, costs, all that stuff. So it should all be whoever's an approved person. Yeah.
And they do, and you might get into this, but they do read differently too. And the reason why is because CCM Smart Start is a down payment assistance program that is a true gift fund
Right.
where we're giving them money. They don't owe us anything back at any point. When you use something like OFA, it's actually a grant. And what a lot
Actually,
of
it's like
people don't-
a second mortgage, kind of like a silent second is what they call it.
Like a silent lien on your
Yeah.
property. Because what people don't realize is if you do go with OFA, and it's still a fantastic program. So
Right.
we're not saying not to use it. However, if you're only planning on being in the property for 2 to 3 years, you do have to pay some of that money back. So it reads different, based on if it's a gift fund or a grant, and based on if it's cross-country mortgage specifically or any kind of state or federal program.
Right, exactly. So that's a good reminder.
And they will ask you.
Yeah. Yes, they will. Okay, guys, as we move down in this example for this conventional first-time home buyer option through OFA, everything, at least in the payment and everything, those kinds of things, guys, are always going to be similar. So based upon that particular interest rate, what we estimated for the monthly mortgage insurance, and what we estimated for the monthly property taxes, in this particular scenario, the monthly payment is going to be $734. And then after, once you get to that 15th year, when the PMI falls off, the payment then goes down to $679. Okay. All right. And here we go. So this particular program, the estimated closing costs, $8,991, and estimated cash to close, $5,337. So everybody's like, okay, well, this is a pretty, different drop. How come if our closing costs are that much, why is our cash to close only $5,300? Well, we're going to go over that right now. Okay. All right. So here's are the fees that OFA sent to us that we have to put in our loan costs as far as an origination. So we have our underwriting fee of $895, a $595 processing fee. OFA makes us charge an origination fee as well of $728, funding fee of $425, administration fee of $100. All these fees are auto-populated from OFA, okay? And for Section A. Then it scrolls down to the same thing with the services that a borrower can possibly shop for. Appraisal fee, $600, appraisal reinfections fee, $200. All of those are kind of very similar to what it was, okay? So same thing with the services you can shop for. And sorry, guys. Go back again. This one. Chubby fingers again. Okay, here we go. No, just stay on that. Okay. All right, so going down here again, all of these itemized fees on here. Okay, so this particular one, down payment funds, from the borrower, $1,500. That is the OFA down payment assistance plus $500 earnest money deposit. So those we can put on here. If it's OFA, we can put on here initially. So it shows you as of what funds are going towards the borrower and what they needed, okay? And then the adjustments and other credits, an additional 1,654. I'm gonna show you that on this next, once we get to the final CD, we can show exactly what it is, okay? But everything else is pretty similar that we went over on the first loan estimate option. Okay, any questions at all real quick before I go to the final part of it? I'm just gonna scroll down and we'll get right to it because for time purposes, I know I wanna try to get through as many of these as possible. Okay, all right, so now we're at our final closing disclosure, okay, that we received 3 days, that we sent to the borrower, I should say 3 days prior to closing. So sales price, $75,000, interest rate, 7.875, that all didn't change because it was all locked in when we did the file. So now we're gonna scroll down here and see what the difference is. Payment, okay, $733.65, so a little bit of a difference, depending upon what type of insurance the borrower may or may not have selected. Okay, now we have our actual cost. So actual closing costs ended up being $7,683.97. Cash to close, $4,649.23. Okay. So now we're going to show down the breakdown of everything that was associated with this transaction. So origination fees, all those stayed the same, like I mentioned, because that's what OFA sets in there. And then everything from B on down are fees that could potentially be different or be applied towards whatever the third party is. So in this particular example, appraisal fee was $595, so that was like $5 cheaper than initially when it was done. This one had an appraisal reinspection fee because this particular property, I remember they had some peeling paint, handrails, a couple different things. And so the appraiser did have to go back out to reinspect the property. So you'll see that on here, the $200 charge did apply. And it's a good thing that we disclosed that initially, or else we wouldn't have been able to charge that, okay, for ZAP appraisals. All right. And then everything else goes on here. You have your title fees, everything like that. That's all being itemized in there. Same with your prepaids, your homeowner's insurance, property taxes, same with brokerage fees, all those kinds of things, all very typical and itemized. All right, so now we're going to go here to the estimated cash to close again. So we'll see the differences where what was paid out of closing was the appraisal, $1,500 deposit from the OFA funds, $500 earnest money, okay? Difference in closing costs and the cash to close was $5,337, which is now $4,649.23, their estimated cash to close. And so on here, again, we'll be able to show them what funds were applied towards from OFA towards their down payment and towards their closing costs. All right, so line L, remember line L shows all the borrower's credits. So we show the $500 deposit that they had, the OFA down payment assistance funds that what applied towards their down payment and what went towards their closing costs. This particular case was, the amount was $3,708 that showed that what was applied, plus the tax proration that the borrower received as well of $481.74. Okay, so that's how they get that estimated cash to close with that amount. So just a good example that I wanted to show you guys was what an OFA kind of LE and CD look like, just so you had an idea in that regard. And then quickly we'll move over to my option 3 here, because I have a couple that are pretty cool here too. This one I think is a FHA loan. Okay. Okay, all right, let me make sure there's nothing in the chat. Nothing, okay, good. All right, no questions at all before we go? Okay. All right, guys, real quick, we'll go over this FHA loan. This is a unique one too, because this is a borrower I know that wanted to get his rate to be a little bit better as well. And I think we have some points factored into this particular option too, which is good to kind of explain what points are and what they do. All right, so this particular scenario, the sales price was $180,000. Okay, borrower's putting 3.5% down. Now that loan amount, that $176,739, that is also including what the upfront mortgage insurance premium is too. So all of that kind of stuff gets rolled in to their financing when it comes to FHA. just in case if you guys just right off the rip, because I'm a numbers guy. As soon as I see something, if I know if it's not exactly 3.5 or 3% down, I'll notice a difference. That's why. Okay, all right. So in this particular case, it shows the principal and interest payment of $1146.33. The PMI insurance, the monthly insurance that FHA charges, $122, and the estimated property taxes, what they're holding for ESCO is $225, so $1493 is what their estimated total monthly payment is going to be. Okay. All right, now here it shows estimated closing costs, $14,933. Estimated cash to close though, $15,286. Everybody's always initial sticker shock. They're always looking at closing costs to see this just looks high. What's actually being applied towards my down payment and so forth. This is why we want to go over these scenarios so everybody has an understanding of what they're actually being charged along with what credits they're receiving. Okay. Now this particular borrower, the borrower wanted to buy their rate down. I can't remember off the top of my head what the rate was initially without any points, but what they wanted to do was to buy the rate down as much as possible to get their payment to where they wanted it. So this particular client wanted to pay 1.66 in points in order to buy their rate down to that 6.75. Okay. And the amount of points was $2,934. Okay. And that just goes, that doesn't necessarily go to us. That actually goes towards their cost of their rate. So it's not like it's cross countries taking that money and we're, doing whatever we got to do with it. That amount goes to this secondary market to lock in their interest rate. We just handle that, protect that particular process for them. Only thing that we have on there is our standard $895 underwriting, $795 processing fee. So I just wanted to make sure and kind of go over that. And then again, you'll see the services the borrower can shop for, appraisal, reinspection fee, credit report, all those kinds of things, mortgage insurance premium. That's the only thing that technically the PMI, the mortgage insurance premium is something that they really can't shop for, but they just wanted, for some reason, they just, the CFPB wanted us itemized in that particular section. That gets actually financed in with their loan for FHA. Okay, then you have your regular title fees, service fees, all those kinds of things. And then we have up here, you'll see the $3,039 under the calculation of cash to close. That's the reason there's a minus there is because that's what's financing in. That's the upfront mortgage insurance premium that's on every FHA loan. Okay, so that's why it's a minus, because it's financed in. It's not an amount that the borrower has to bring to closing. Okay, so then it shows what their down payment is to $6,300. The deposit of $200 roughly for, and maybe that was just, I think, their earnest money deposit. So their total cash to close, including their down payment and closing costs, is going to be $15,286. Okay, so they're 3.5% of 180 plus their closing costs. Now we'll get into the final CD of this version here, just so you guys can see what it finally looks like when it's with when FHA's is done on the final CD. So here we go, back to the 170 purchase price, same interest rate, 6.875, monthly principal and interest payment, $1,082.64. Okay, everything here again, the mortgage insurance was about the same. Estimated escrow account that we're holding for taxes and insurance, $233.12. Now that we have all their fees and everything accounted for from all the third parties involved, their closing cost did drop to about $13,348.40. Now bringing their total cash to close, including their down payment and closing costs, to $13,943.60. Okay, and I'm going to go to the section that shows the differences between the two and what was applied. Okay, all right, so here we go. So once we got their all their proper fees calculated in the system from the title company, all the third-party people that were involved, we had their total closing cost initially was $14,933, ended up being $13,348.40. Okay, then we started factoring what their credits were. Closing costs being financed ended up being the $2,870, which was the upfront MIP, because I think there was an adjustment to the loan size. Their down payment $5,950, cash deposit $200. That's adjustments and other credits, tax prorations and things like that was $1,589.80, making their total cash to close, including everything, $13,943.60. And then I'll show you here, once we get to, here we go. All right, so right here, this particular borrower, their deposit was to $200, and then half the titles policy in this example was $573.57. Tax proration that they received from the seller was an additional $1,016.23, making that's what their cash to close to be of the $13,943. Okay. All right, guys. So I know it was a ton. I was trying to not go too fast, but I wanted to go over as much as I could just so you can kind of hear it at least, because I know we only get an hour here, but just wanted to make sure any questions or any scenarios that anybody wants to go over or discuss. I did have a fourth option here, which was a VA loan, which is really cool too. So we can touch base on that as well. But I wanted to answer any questions you guys may have, because I know we only got a couple minutes left, and I know you're the ones that are here getting hungry and they can go eat. So any questions at all real quick?
Does the, I know like some of the appraisal fees were different.
Yes.
That's just based on the type of loan too, if it's FHA versus conventional.
That's exactly it. That's exactly it. Aaron made a great point, guys. He noticed a difference in the cost of appraisals, and that's really due to the program. Because when you have a conventional appraisal, you know, everything that the appraiser goes out there and marks, he has their set of rules and what they look for and what they kind of go off of. Okay, then you have a borrower that has an FHA loan where it's a little bit more in depth. The appraiser's gonna have to do a little bit more work. So they're like, okay, yeah, we'll do FHA appraisals, but it's gonna cost a little bit more. So, and depending upon if it's a single family, if it's a 2 to 4 unit property, you know, those could also dictate as well what the actual cost of the appraisal might end up being. All right, food. What kind is the reason? He's like, what kind of food is there? You got to come in and find out, man. All I can tell you is that it's edible.
There's already scavengers out there looking at it, trying to
Yep.
blame.
Yep. Yep. So, but yeah, but real quick, I'll just kind of go through this. So just so you guys can kind of see real quick about a VA option. This particular borrower too, this was another one that I had closed, and they, you know, had a little bit of extra money too, and they wanted to buy their rate down also, I believe, on this one to get it to 6.75 to get them locked in for their whole duration. All right, so this particular example, no mortgage insurance on this one, obviously, because it's VA, because they don't require that. So it doesn't matter if it's 100% financed or not, there's no monthly PMI. So, which is great. So this particular example, the principal and interest is $1,524.21. Estimated escrow, taxes, and insurance is $257. So their total monthly payment, including everything, $1,781. Okay. All right. Now, this particular example, the borrowers, their estimated closing costs, $13,717. Excuse me, and their estimated cash to close, $26,709. Okay, and the reason for that, real quick, let me just show you. I wanted to go over.
I need to know this stuff little by little.
Oh, there's some. Hold on. Okay. Yes. Oh, Constance, did you have a question?
No,
Oh, okay. I just wanted to make sure.
no, I just said thank you.
Oh, yes. You're welcome. You're welcome. Thank you. Okay, guys. All right. So this particular example, the borrower wanted to buy their rate down to that 6.75. And at this point in time, when I locked them and got everything in, the total cost of points to get their rate to that was 1.589. And so that cost based on the loan amount size was $3,734. And then our origination fee, which is our processing and underwriting, still stay the same at $1,690. So those factor in is what CrossCountry can control, because we take that money for their points and give it to the secondary investor to lock them in at that rate. Okay. All right. On this one, appraisal fee $625. Same thing. Reinspection fee $200 was on there listed. Everything else looks pretty standard on here. And I wonder if this was an example. I can't remember if this one had the VA funding fee. This one may have been exempt. I wanted to kind of show you what that was, but let me double check to see if I had that on there. I don't think I did. Okay. All right. But this particular borrower, you know, the reason that their cash to close is so high is because they were also paying some things off. And I'll get to that too. I wanted to kind of give you something fun here at the end too, to kind of see like why their cash to close was so high. All right, so let me scroll down from the loan estimate. Okay, here we go. All right, so now here's our final closing disclosure at the day of closing for this borrower. So purchase price $235, loan amount $235, because there was no VA funding fee, so we can see, hey, what are we financing as a total. There's no funding fee to have rolled in there on top of their purchase price. So we finance $235, rate at 6.75. Total monthly payment, including taxes and insurance, ended up being $1,806.86. And I'll show you why the difference was between that was because they chose a little bit higher of home insurance than what we had initially estimated. Okay, all right. So their estimated cash, the closing cost actually was then lowered to $11,777. Estimated cash to close $25,094.87. And I'm going to show you why their cash to close is so much when this is 100% financing. Okay, same with the charges here. Points, costs, registration fee, all those things stay the same, which is what we do on every deal. Whether it will be if there's points or not, as far as origination fee, that's our same. Okay, and let me see. Let me scroll down. This was another good Keller Williams deal that I had gotten. Okay, all right. So here's again another breakdown. Estimated closing costs initially were $13,717. Final $11,777. So it shows what their total amounts were going to be. Now I'm going to scroll and show you what we're paying off. Okay, here we go. So we have our closing costs, and then see on there you will see it says Farmers National, that Farmers NTL. That's an amount of what we were paying off. They had a $15,016.70 loan that we were actually paying off for them, you know, during this process for qualification purposes. So that amount is being shown right there, what we were paying off. So we have their closing costs plus their $15,000 that they were what we were paying off. Then we have our title policy credit, $715.88, and then the tax proration of $906.72, which gave them those other credits, making their total cash to close $25,094.87. Okay, so I just wanted to hit on that real quick. I know we're at our 12 noon time though, but any questions, guys? I mean, this was fun. Hopefully you learned a little bit. This was informative. I know Kate and I had some really good points, and just wanted to make sure to kind of respect your time as well. But any questions or anybody that you could think of or anything you want to add, Kate?
I think you nailed it.
We got it all, I think. So I know it was a lot in an hour's time, but it's just important stuff that we feel you guys should know, at least have a general understanding about, so you can kind of feel what your borrowers are going through and what we talk about when we're talking about cash to close and what funds that we can or cannot control, those kinds of things.
And honestly, there's like and I said we pointed out some questions that we usually get right off the rip, but now at least when the client calls you and is like, oh my gosh, I thought my cash to close was going to be so much lower. Instead of you panicking and being like, why is it so expensive? You can now have the understanding of being like, it's okay. They have to list everything. It usually won't be that much. Actually, it's never as much as they initially quote you. That way, at least you guys have peace of mind too. And this is why we do it this way, so that there's no panic at the end.
And that's why you see each one of the 4 options that I showed you here, you know, the actual cash to closing, every scenario was always less. It's because everybody has to over disclose normally up front for compliance purposes. It's not like we're trying to be like, hey, we're going to charge you this. You know, we got to make sure that everybody has the right fees disclosed, so no one has to eat that fee.
For sure. And lunch is ready.
Yeah, lunch is ready. Zarice was wanting to know what we were having.
Well, Zarice, you don't get to know.
Yeah.
So,
all right, guys, thanks so much. We'll hit the pause, the recording, stop recording.
Yeah.